Today, we're taking a really high-speed shortcut into one of the most aggressive and contrarian financial analyses we've seen in a while.
Yeah.
We are going deep on TLRY brands, that's ticker TLRY, and we're focusing entirely on this single, fiercely bullish report that, frames the recent stock weakness not as a warning sign, but as the perfect opportunity.
And the source material, it's just pure high-conviction forecasting. It was written right when the stock was dipping, trading around, what, $9.28?
Exactly. So if you were watching that day, you just saw red everywhere, a drop of over 3%. That typically spooks investors, especially right before a huge catalyst. But according to the blueprint laid out in this analysis, that drop is explicitly defined as a TLRY appui. So our mission today is to really unpack the specific logic behind this aggressive call. Why does this analysis see a price drop as a buying signal? And why is it predicting an earnings explosion leading into that big January 8th, 2026 earnings report? We are going to distill the arguments for those who think this stock is ready to ride to $15. Okay, let's unpack this.
And for you, the learner, this deep dive is it's really essential for understanding more than just one stock. It's about recognizing a very distinct style of market analysis. The contrarian, high-risk, high-reward approach. We're synthesizing how certain market observers actively interpret these negative short-term signals as, well, strategic opportunities, especially when they're anticipating big news, like regulatory news, that the broader market hasn't fully priced in yet. The goal here is to fully grasp the case these investors are making.
All right, so let's start with the heart of this contrarian view. This idea that the recent slide hitting that 928 mark is just fundamentally misleading. The analysis insists this is not a sign of genuine weakness.
No, not at all. Instead, it's being deliberately characterized as a technical move. One designed to, and I'm quoting here, flush out the weak hands right before the anticipated rally, or what they call the earnings pump.
That's a bold claim. It almost implies intentionality.
It does. And when they use that term weak hands, they're talking about, the retail investors, the ones who might panic sell based on some short-term fear. The analysis frames this whole price action as pure consolidation.
And consolidation, just for anyone who's not familiar, it's not a crash, right? It's more like a pause.
Exactly. It's just the market taking a breath. It's a period where the stock price might move sideways, maybe even dip a little, as buyers and sellers just sort of digest the recent run-up.
It prevents the stock from getting too hot too fast.
Precisely. And what's fascinating about this analysis is how they interpret that pause. They point to the long-term trend. The stock is still way up from its 52-week lows. They argue that this recent dip is just proof that the long-term upward trend is, well, completely intact.
I do have to ask, though, the analysis uses some really aggressive language, like smart money is accumulating during this drop. How much of that is, real strategic positioning versus just hype to get other people to buy in? It starts to sound a little manipulative.
That's a critical question. And when an analysis uses a phrase like load the boat, they are definitely injecting some emotional confidence into it. But their core technical argument isn't baseless. They argue that going into earnings after a measured pullback rather than on some vertical crazy run is actually a healthy signal.
Ah, okay. So if it had just gone straight up without stopping, people would be worried about a sell the news event.
Exactly. A massive sell-off right after the earnings, no matter how good they were.
So a pullback before the news kind of cleanses the excesses and it creates space for the next leg up.
Precisely. They position this as a classic load the boat setup because they believe the institutional money is actively using this short-term negativity, this fear from the red day, to accumulate shares on the cheap. They see the most profit potential if they can maximize their share count before that January 8th catalyst hits. It's a huge bet on future news.
Okay, here's where it gets really interesting. Because they back up this whole psychological argument with some specific technical evidence that they claim validates this bear trap. Let's look at the charts they are studying.
Right. They focus on two specific indicators that, in their view, prove this 928 dip is just a temporary accumulation zone. The first one is the successful holding of the psychological floor at $9.
Why is $9 so important? It's just a round number.
It is, but psychologically, these round numbers act as really strong magnets and anchors. Big trading algorithms and, human traders, they tend to place buy or sell limits right at these even numbers, like $9 or $10. So holding that line, even with that 3% selling pressure, it indicates that a pretty significant amount of capital stepped in to defend that price.
So it suggests there's real support there. It wasn't going to collapse into the eights.
That's their argument. In their view, if the stock had broken $9 convincingly, the whole bullish thesis would have been, well, immediately invalidated.
Okay, and the second technical detail they brought up was about the volume profile. This is key to spotting that weak hands action, right?
Correct. They looked at the selling volume during that dip, and the analysis characterized it as relatively low, when you compare it to the much heavier buying volume that was happening the week before.
Okay, let's make that crystal clear for everyone. If the price is dropping, but the selling volume is low, what does that actually imply about who's doing the selling?
Think of it this way. If the price of something drops, but you only see a few people selling and none of the big players are getting rid of their inventory, it tells you something. It tells you the major players aren't distributing. So the analysis concludes that low selling volume on a dip means two things. One, the sellers are probably retail traders, the weak hands getting shaken out. And two, the institutional investors are not selling their shares. In fact, they might be actively buying what's being sold.
So the lack of big volume on a red day signals that the sell-off is kind of exhausted before it even really starts?
Precisely. This signals the stock is just taking breath and allowing the relative strength index, the RSI, to start cooling off.
And the RSI is that momentum indicator. It measures the speed and change of price moves. So a high RSI usually means the stock is overbought and it's due for a correction, right?
That's right. A reading over 70 is often seen as overbought territory. By dipping now, the analysis argues that the RSI is pulling back from those danger zones, maybe down towards 50 or 60.
Which is much healthier.
Exactly. This cooling effect ensures that when the positive earnings news hits on January 8th, the stock won't just crash because it was technically overextended. It sets the stage for a sustainable rally after the catalyst. It gives it the technical room to move towards that $15 target.
So the chart signals are set, the trap is sprung, the floor is holding, momentum is cooled off. But charts only get you so far. A real rally needs some fundamental strength. Let's shift our attention here and address the fundamentals. Why is this analysis so convinced that the January 8th earnings report is going to deliver massive growth?
Well, the foundation of their fundamental bull case rests entirely on a strategic business shift. One, they believe the market still really underappreciates, and that's the alcohol pivot.
Right.
The analysis argues pretty emphatically that Tilray shouldn't be seen just as a volatile cannabis company anymore, but as a rapidly growing cash-generating beverage giant.
And they name specific acquisitions to back this up. They're moving way beyond cannabis to get into more traditional consumer goods.
Exactly. They cite the continued success and what they expect to be growth acceleration of their craft beer portfolio, specifically the Sweetwater and Montauk brands.
And these brands provide stability, predictable revenue.
That's the key distinction. The strategic importance is diversification. The cannabis sector is still, it's hampered by regulatory uncertainty, high taxes.
Which leads to volatile margins.
Incredibly volatile. The alcohol market, though, it's mature, it's regulated, and it generates consistent, strong cash flow. So the analysis views these beer brands as a stable cash flow engine that provides Tilray with reliable revenue while the company just waits for those big regulatory changes in the U.S.
And they expect to see that growth showing up in this report.
They do. The report states they expect to see massive growth in that sector, showcased in the upcoming quarterly report. It suggests the pivot is already working.
And beyond just the revenue streams, the analysis put a lot of weight on their balance sheet health, specifically the cash position.
In this high-interest environment, that's huge. Capital is expensive.
So sitting on cash is a massive strategic advantage.
It's a critical safety net and a weapon. The analysis points out that Tilray is sitting on over $200 million in cash. Yeah. And why does this matter so much right now? First, flexibility. They can fund operations and growth without having to take on new, expensive debt.
And second, it minimizes dilution, right? They don't have to issue new shares, which waters down the value for existing shareholders.
Precisely. If a company without cash needs capital, they often have to sell more stock, which pushes the price down. Tilray's cash reserve is seen as a huge advantage over competitors who might be struggling.
So they're perfectly positioned to expand or acquire new assets when the time is right?
Without compromising their shareholders. That's the argument.
Okay, so you've got the technical setup, the cash safety net, and the cash flow from beer. But let's be honest. The thing that drives a potential move from $9 to $15 is not just Sweetwater sales. It is the regulatory wildcard.
Absolutely. This is the definition of a high volatility catalyst. The technicals and fundamentals are setting the stage, but the regulatory speculation, that's the fuel for the explosive move. The analysis goes into detail about the huge expectation around the CEO's commentary on that January 8th earnings call.
They specifically mention the Step 3 rumors related to potential U.S. rescheduling intensifying in 2026. We need to unpack that political jargon. What are these Step 3 rumors? What does that actually mean?
It relates to the federal review process for cannabis classification in the U.S. Right now, cannabis is a Schedule I drug, which puts it in the same category as heroin. It means it has no accepted medical use and a high potential for abuse.
Which is, clearly outdated.
Well, the ongoing administrative review is evaluating whether to reschedule it, potentially down to Schedule 3.
And what is Step 3 in that process?
Step 3 is typically where the Drug Enforcement Administration, the DEA, formally acts on the recommendation that was already made by HHS to move the substance. The expectation is that 2026 is going to see some intense political and regulatory movement on this. The analysis says the market is just on edge, hanging on every single word from these CEOs.
So the actual earnings numbers on January 8th might almost be secondary to a single quote about rescheduling.
That is the core tenet of this whole thesis. The analysis suggests that if the CEO simply drops one hint about positive regulatory talks, a non-denial, a subtle prediction, the stock could immediately jump toward that $15 mark overnight.
Driven purely by speculation?
Purely by speculation and the anticipation of massive future financial gains.
Okay, let's talk about those gains. Why would rescheduling from Schedule 1 to 3rd justify a 50% jump in valuation?
Well, the change provides two immediate and just huge financial benefits for companies like TLRY operating in the U.S. The first is tax relief. Under Schedule 1, these businesses are subject to IRS Section 280E.
And that's the one that forbids them from deducting normal business expenses, right? Like rent, utilities, payroll.
Exactly. It is a massive burden. They're paying taxes on revenue, not on profit. Moving to Schedule 3 would eliminate that 280E burden, instantly making these businesses vastly more profitable on paper.
And the second big benefit would be banking access.
Right. Schedule 3 suggests medical acceptance, which would greatly reduce the reluctance of major banks to provide standard services, loans, credit access. It would just make the whole sector more efficient.
So if we connect this all back to the bigger picture, the analysis is saying the technical floor is holding and the selling is weak because the smart money is anticipating these massive tax and banking reforms.
That is the precise conclusion they draw. They're betting the political landscape is about to validate the technical accumulation phase they've identified.
Let's close out by looking at the actual price targets the analysis lays out. They weren't shy about the upside potential here.
No, they lay out a whole spectrum. First, they cite the broader Wall Street consensus, noting the average price target among established analysts is $14.50. That represents a potential 50% upside from that $9.28 entry point.
So even the more cautious analysts believe the stock is undervalued.
That's what it suggests, yes. But then they throw in the extreme targets, which rely entirely on that regulatory windfall.
How high do they go?
They mention some aggressive bullish targets go as high as $25, essentially predicting a valuation increase of over 150% if things turn truly favorable. Their final summary is a judgment on the current situation. The risk-to-reward ratio, in their view, is absolutely skewed in favor of the bulls.
So they conclude that selling at $9 now would be, what was the quote, the definition of regret?
That's the one.
So what does this all mean? We've looked at a financial analysis report arguing a recent drop is a technical illusion, a bear trap, validated by a holding psychological floor and low selling volume. This setup is backed by the fundamental stability from the alcohol pivot and a lot of cash, all pointing toward an explosive, politically driven catalyst on January 8th.
Yeah, the core philosophy here is rooted deeply in investor psychology. It's contrarian thinking. The final thought they present for you to consider is that the market often hides its biggest gifts, the opportunities for the largest gains wrapped in red days. And this period right now, just before the quiet period ends and the news cycle really begins, is framed as the ultimate fleeting accumulation phase for those willing to buy when others are scared.
Given that this analysis predicts absolute regret for any current sellers, it makes you wonder how much the fear of missing out the FOMO factors into this type of highly aggressive financial forecasting. It certainly encourages you to look past the immediate headline of a down day and really investigate those technical concepts of consolidation, psychological support, and low volume selling, doesn't it? As that clock ticks down toward January 8th, understanding the potential impact of those Step 3 rumors is really the key factor to watch.